But I want to put a question to Warren Ingram this evening. And Warren Ingram is a financial advisor. He's a director at Galileo Capital. And why on this planet, Warren Ingram, should anybody ever buy a share in anything ever again, considering, and here are the facts, that Christo Wiese joined the board of Steinhoff on a recce for 2 years before he then sold Pepco to Steinhoff, took Steinhoff shares and took the listing to Germany, and to only watch 98% of the value that he held in those shares disappear into the night like a thief. I mean, if that guy can't get it right, how can any of us ever get it right? Discuss.
Thank you for the hospital pass.
No, anytime. I mean, I know it's not what we discussed, we talk about, but it strikes me as pertinent on a day like today. If Christo Wiese can get duped, and he says, no, dupe's a strong word, but if Christo Wiese can have the wool pulled over his eyes, I think that was a term that he might have used in Parliament, then how the hell are the rest of us meant to cope?
So it's a very good example of things blowing up, and obviously, if we spend enough time, we can come up with quite a few more good examples of things blowing up. But at the same time, we can come up with many other great examples of things not blowing up, and great companies listed both here, internationally, doesn't matter, that for decades have rewarded investors with no scandals and no major events bar normal stock market events, and so I think to get discouraged from investing because of the big obvious blow-ups, to me I think would be a mistake. I think and unfortunately it's something that a lot of people, it's a trap a lot of people fall into, because that always makes the news. So 20 years of growing dividends consistently and below the radar, and rewarding your shareholders day after day, week after week, that doesn't really make a newspaper headline until 25, 30 years later, and then all of a sudden you're Warren Buffett and you're world famous. But take the first 20 years of Warren Buffett's career, where he was really helpful and really rewarding to the early shareholders, and he just wasn't really in the news. And that, and look at him and his business today. There are no scandals, and whatever scandals there've been, weren't of his own making. So to me, I think it's sad that we have something like a Steinhoff blowing up, and really smart people, both at board level, and it wasn't just Christo Wiese at board level. There were lots of people at board level, and I think really good, strong, ethical people that had the wool pulled over their eyes. And to me, if that's the conclusion people take out of this is that stock market investing is bad, I think that's, the economic impact of that is much worse than just the Steinhoff impact.
Okay, so then I want you to prove your point, all right? So if this is an anomaly, if this is an aberration, this and African Bank and a couple of others before it, but these are aberrations rather than the norm, then there are people who react to the aberrations and say, well, my money is safer under the mattress or under my pillow, or in my case, in a very small shoe. We can't risk it on the stock market, because the stock market is a risky place. Just look at what happens when things go bad. Even Christo Wiese got caught out. I'm going to keep my money in cash. And the brutal reality is, and this is the point I was leading to, there was a point to this, that you actually will do yourself considerably more harm by being cautious than by having a sense of adventure when it comes to money.
Absolutely. It's almost like we've discussed this before. So to me, I think the best way is always by example. And so, if you're going to take an example, then try and be as current as possible. So what I did for tonight was to say, let's look at the last 30 years and see, or even actually further back, as far back as we can possibly go with all investments in South Africa. In other words, shares, bonds, cash, listed property, and just see what happens to investors when they make good decisions and when they make bad decisions. So I said, okay, let's take two people. They retire at the age of 65. And one person does what you've just discussed. They read the Steinhoff news, and they decide that's it. They've heard the Bruce Whitfield interview with Christo Wiese. This is a joke, this investing thing. I'm not doing it. So they put their money in the bank, and it's hopefully not one that fails, and they do nothing. So they leave that money in it. In this case, let's just say it's $5 million. And, and that's a sizable retirement for most people. And they say, okay, I can live on 250,000 Rand a year. So that's what they do. And every year, they retire at the end of December. So every year on the 1st of January, they increase that 250,000 Rand that they're drawing out of their money by inflation. It will take them 22, bless you, Puff. It'll take them 22 years to run out of money. And that person will be 87. Now,
and there's a good chance that you'll get to the age of 87 if you've led a wholesome life. There's a good risk that you'll get to the age of 87.
Exactly, and if I see just how rapidly the life expectancy is accelerating, it's not ridiculous that you actually need to plan to age 90 or 95 nowadays. I've always said, for the last 20 years, you need to plan to age 100 because of the rate of progress of medicine. You might not be the best quality life, but you'll be there. And so, there's a person that's now, felt safe every single day. If they check their bank balance every single day, they would not ever have seen a negative drop because of a Steinhoff or anything like that. They just saw their interest adding itself, and they wake up 22 years later and they've literally run out of money. And that's, to me, a devastating outcome. So they wanted certainty. They wanted to know that their money was always going to be safe. So that certainty has cost them enormously.
Let's pause on the certainty, because I think it's a good place to pause. My guest is Warren Ingram. You know him well. You may even have read his books, and if you haven't, why have you not read his books? You should read his books. You should follow him on social media. You should follow him on Twitter. It's at Warren Ingram, right?
Yes, it is.
There we go. In the same way they spell the cream. There, Ingram. He's very slick. Warren Ingram, he is a financial advisor at Galileo Capital, and he is also a director at Galileo Capital. I must just tell you that there's a big problem on the N3 South. Just before the Modderfontein off-ramp, cars are backed up really badly. A truck has jackknifed over the road, and that's going to destroy a whole bunch of people's weekends as you head south. On the N3 this evening, if you can avoid that mess, please do your best to do so. Bitcoin, crypto bubbles, passive indexation, futures, swaps, annuities. There's a lot of financial jargon flying around. But if you don't understand it, how do you know whether or not it could be right for you? Old Mutual can help you make sense of it all, and they can give you the great financial advice that you need to make the right decisions. If you've got a question or want to know how to make the most out of your money, you can call them on 0860 60 60 60 or speak to an Old Mutual financial advisor or your broker. Today's the day. Get great financial advice so that you can do great things. Old Mutual is a licensed financial services provider.
The Koketso Sachane Show, Mondays to Thursdays from 8 p.m. and Sundays from 9.
KK, if I didn't know you were black, I would have thought you are a DeLille's son. You are obsessed with this woman. So funny. I am very obsessed. You know why? There is a caucus deciding on the future of the executive mayor of the city of Cape Town. And just because I'm black, how do you know that I'm not her son? How do you know? Do you know my mother?
Koketso Sachane on Cape Talk, your number one news and talk station.
Looking for a venue to host your company's next conference? A venue to host an intimate event? Or a place to play a round of golf with some friends? Then come to the River Club. Centrally located, the River Club offers conference rooms, use of their golf course, catering and a host of other services at affordable prices. Plus you can enjoy free Wi-Fi and free parking. So no matter the occasion, remember, the River Club has everything to make your event or conference unforgettable. The River Club. Convenient, fun, memorable.
In today's on-demand economy, my business demands that I hire skilled professionals that deliver results. That's why I choose recruitmymom.coza. They have savvy, skilled candidates for permanent and contracting positions. From project managers and digital experts to accountants and marketers, Recruit My Mom has top caliber candidates throughout South Africa that work flexibly or part-time to get the job done. Post your job free today on recruitmymom.coza. Smart, skilled recruiting.
Telkom knows that being business savvy is about the numbers. So we've slashed our prices on unlimited DSL and fiber. Boost your business with 4 megabits per second on unlimited business now for 649 Rand per month. Or get 10 megabits per second on unlimited business now for 849 Rand per month. Plus, unlimited calls, uncapped data, free mobile data, and so much more. Call 10213 or go to any Telkom shop. T's and C's apply. Switch to Telkom.
The Money Show, Personal Finance.
Personal Finance brought to you by Ned Group Investments. See money differently. Ned Group Investments is a registered unit trust manager. Warren Ingram, financial advisor at Galileo Capital. We're talking about why it is that you need to be invested and why it is that your money needs to grow and why it is that if you don't allow your money to grow, in other words, if you don't put it into assets that grow faster than inflation, that outperform cash, the only certainty that you will get is the certainty that if you live long enough, Warren Ingram, you will run out of money.
Absolutely. And it's all about, in that instance with cash, it's all about the buying power of your money and how that gets eroded by this horrible I word, and it's not the Ingram word, it's the inflation. And that's the issue here. So if we look back 30 years, what cost us $100, so if we just said, let's go and buy a typical, basket of groceries that cost 100 Rand 30 years ago, today that costs you 800 Rand. And that's the impact of inflation, as basically as our own groceries. And the problem with cash is it just doesn't have a history of beating inflation. It's over any kind of extended period of time, inflation will wipe out the buying power of your money, and that's the big problem with the certainty of cash. It's not going to help you.
Okay, so we're talking about a 65-year-old person who, if they're fortunate and if they've been responsible, at the age of 65, they decide to stop working altogether, have no additional income, but they do have 5 million Rand that they can invest for their retirement. They need 250,000 Rand a year to live. Put it into cash and they run out by the age of 87. So what is the alternative?
So then I thought, let's not be too clever with this. Let's just take someone who says, okay, I'll take half my money and put it in shares, and the other half I'm going to put into the bond market. So, something that looks completely different from the share market. Generally, if you don't buy, Russian or Brazilian or Greek bonds, quite a safe place to put your money. And they do nothing with that money. So they literally buy half shares, half bonds, and they do exactly the same as the person with cash. In other words, they draw their 250,000 Rand a year, and at the start of the year, at 1st of January, they escalate that 250,000 with inflation. That person will also run out of money, but they're going to run out of money at the age of 100, 35 years later. And to me, that's a win. That's a fair result. If you make it to 100, I'm sure there'll be some kind of charity that'll look after you by then. The extra old age charity or something. But that extra gap between your money living for 22 years and 35 years is explained by embracing a little bit of uncertainty, by embracing the prospect of many sign-offs happening over a 35-year period, and lots of bad headlines and big media outbreaks about share market collapses and blood in the street, etc., etc. All of that will happen to you, and you'll still be okay. You'll still be at the point where your money can last that long for the remainder of your lifetime.
What gives you that certainty? I mean, one looks at 1929 and the greatest stock market crash of all time, where the value of shares lost 90% over about 3 years. And by 1932, markets bottomed out. And it took up until 1952 for the Dow Jones Industrial Average to regain the levels it last saw in 1929. There were two generations of people who stayed invested, hit the crisis, stayed invested, and hoped that things would recover. And for those people in those generations, they got trapped.
They did, and I think there's quite a few even more modern examples. Where if you bought the U.S. stock market in the year at the end of 1999, just as the IT bubble burst, you were at zero in terms of growth 10 years later. And so this is the growth and the projections that I'm showing you include that time period, includes 1929. So what we're dealing with always is probability. And remember, it's not a case of saying take all your money and put it in the stock market. It's a case of saying take half your money and put it in the stock market, the other half into the bond market. And I think 1929 was a great teacher to investors. It was also a great teacher to regulators, both of stock markets but also of banks. Because one of the big things that happened in 1929 when the stock market started to crash was people that were not exposed to the stock market at all. They just had their house and they had a mortgage. The banks would kind of invite them for a meeting a month or 6 months into the crash and say, look, we're calling in your mortgage now, your 20-year mortgage. We want you to pay all of that money tomorrow. because they were allowed to do that. That was, the law was different then, and so there was there was a major sort of knock-on effect to many other institutions, not just share investors that caused that sort of two-decade problem. And I think if you look at investors in the stock market at that time, the current cryptocurrency craze reminds me a heck of a lot of the market leading up to 1929, where people were just buying on credit, short-term debts and selling their houses to invest, because the stock market could just never go down, and people were tripling their money every 6 months and that kind of thing. So there was an element of craziness which I don't think we'll see in the stock market again. We'll see it. We are seeing it in the cryptocurrency market. But what we're never going to see again is banks calling in mortgages on people who haven't defaulted, who are paying and doing what they need to do. And a lot more financial regulation now that that prevents the kind of misdeeds that we saw at that time.
Well, there'll be other misdeeds, though. There'll be other misdeeds. But here's the point. Inflation is going to corrode your money. It's going to corrode the value of your money over time. You do have to have growth assets. You do need to accept that these things are going to be volatile and unpredictable. You are going to have to accept that volatility, in as much as it, may shorten your life expectancy, if you can weather it, also provides opportunity for investors to buy more of what is volatile, provided it's not Steinhoff.
Exactly, and I think I must say I started getting quite a lot of calls, after Steinhoff started to collapse, in December. People saying, should I buy now? And it seems funny, but they all started phoning at about 17 rand to the Steinhoff share.
This is so funny because I was at an investment conference this week, and this story was relayed by somebody completely unconnected to you. It's very funny.
So it's amazing how we think, almost, collectively at some point and become a herd. And my argument there was, we're not just dealing with a business that's being punished for an adverse market condition or adverse publicity. We're being punished, a business is being punished because of a major debt issue, which might be multiple times bigger than we all thought. And therefore you cannot buy a business like that with any kind of certainty right now, because, if you thought it was worth 100 billion and the debt was 50 billion, and actually it turns out that it's worth $500 million and the debt is 50 billion, you don't have a business. You, as a shareholder, you have nothing. You're going to be washed out there. And so, I think that one thing to understand about volatility is, if it's affecting the broader market, that becomes a great buying opportunity. So where the whole stock market suddenly takes a big smack because Donald Trump decided to start another trade war, this time with Europe, for example, because they don't like his hairstyle or whatever the deal is, that would be a great time, because what it does is it gives you an opportunity to buy great businesses that are great businesses that happen to be knocked down for the wrong reasons, because people simply are acting like a herd and just not being rational. That's a heck of a time to buy.
And also bear in mind that markets obey the laws of physics. I mean, they may be elevated for a period of time, but eventually gravity does take hold. And fluctuations in value do happen. There are collapses, there are crises, there are moments of broad panic, but invariably markets tend, or at least historically, have tended to self-correct in many ways.
They do, and I mean, so it's actually quite astonishing if you go and look at through a normal calendar year. So just 1st of Jan to the end of December every year, the JSE will regularly lose 10% of its value at some point in that calendar year. So just to put that in context, so you buy it at let's just say 55,000 is the index level at the start of January, and somewhere along the line you're looking at the index and it's 50,000. But what's remarkable is the JSE generally grows in more years than it loses value. So even though you have a year where you end up making money over a 12-month period, somewhere in that year you will see your portfolio of investments down 10%. And if you phone me and ask me a question on this show, I'm going to say to you, don't worry, that's normal. And I know that sounds crazy just after you've lost your money, but that's why it's important to know that now, that's normal. That's just the tide coming in and out, and the point is, you can't get to your destination if you're not in the ship. And in this case, it's investing.
Warren Ingram, thank you, as always, for giving us some really good insights on, despite a provocative start, you understand. But it was a useful way to illustrate the point that many, many people react very emotionally to bad news, whether it be in stock markets or anything else, and make bad decisions as a result of those emotions. mustn't let your emotions cloud your ability to build long-term wealth. That's the lesson that comes through very, very often. Chatting to Warren Ingram at Galileo Capital. If you've not read his books, if you've not bought his books, borrowed his books, or at least attempted to shoplift them, not that we're condoning that. That's bad. Don't ever do that. Pay money. And How to Make Your First Million. Read that one first. And then, once you've mastered that, read How to Become Your Own Financial Advisor. Two really good books on thinking and managing money.